Ladies and gentlemen, welcome to another episode of Be the Bank, the very best place on the internet to learn about the secondary mortgage market. My name's Robert Haitha, your host, founder of FIXnotes. It's my job every episode to show you what I know about the mortgage industry, specifically the secondary mortgage industry, where investors buy and sell distressed and reperforming mortgage notes secured by real estate. So I want to thank the now 87 members of the Mastermind membership group now and get right into our episode, which features our fish friends. Nobody's coming out to play just yet, but hopefully we'll see them soon. All right, let's get right into today's episode. Get my final camera angle set up here, and let's get right into it. All right, so today's episode number 36 on August 25th. We're gonna start with some free resources for note investors. We're gonna go over the industry overview. Then we're gonna talk tech, how you can run this business with a laptop and a cell phone from anywhere in the world, asset acquisition opportunities, finally some case studies after we talk about today's topic, similarities between COI, caretaking, and note investing. And then finally, some giveaways. I'll show you how you can get on a free conference call with me. So as I mentioned last episode, we actually had a problem with the songbirds in our neck of the woods here, but the birds are back. I mean, there's none out there right now, but we could at least sanitize our feeder and get that all filled up again. So hopefully we'll be seeing some feathered friends today, along with our fish friends. Maybe we'll see a dragonfly on this angle. And hopefully there's some little goldfish down there in the lower right. We'll keep an eye on our friends as we go through today's episode, starting with some free resources for note investors. So I do want to pitch what FIXnotes offers, because most of it is all for free. And it starts with our website, a resource for this industry. We've got our course, How to Invest in Mortgage Notes. Our course is 100% free and goes through pretty much everything you need to know about this business to get you started. We also have our industry news aggregator, where we track the recent ongoings in the industry across the entire marketplace, and you can get the recent news there. And then we've got our mortgage note inventory for sale. You can review assets that are on the market for purchase as well. But that is a limited mortgage note inventory. If you want to access the complete mortgage note inventory, including opportunities available today, you need to join the Mortgage Note Mastermind. For savvy entrepreneurs, that includes private events and Zoom calls, our vendor database, forums and activity feeds, case studies, databases. There's a whole bunch more there. You can definitely learn more about it by going to fixnotes.com/MNM. And then you can also consult with me at fixnotes.com/consult. I can offer you my expertise on a range of topics curated specifically to your needs. I put out the show every single month for free, but you can get a little bit more information from me by being a paid consultant member. So if you join the Mastermind today, it's actually not $100 a month. We just filled our last seat, and our first 2 seats actually at $110 per month. We increased the price by $10 for every 10 new members. So you definitely want to lock in your price today, because it continues to go up eventually to over $900 per month once we reach close to our limit of 1,000 members. That's the cap. We're never going to raise more than 1,000 members in this group. And if you join the Mastermind group, you do get 50% off consulting. So that comes out to $180 per hour for members. So definitely consider that if you want to take your note business to the next step. But let's get right into the show, because we have so much free content on YouTube and on our website to share with you. You don't have to join the Mastermind yet, but when you're ready, I'd encourage you to consider it. All right, so first with the industry overview. There's a live event coming up September 30th to October 1st, the Diversified Mortgage Expo. Now, this is an event I've went to many times in the past. It used to be in Newark, New Jersey, which isn't too far from Philadelphia. So I would drive up there and bring all my conference materials. I'm not flying this year for a couple obvious reasons. If you tuned into last episode, my wife and I are expecting our first in the middle of September. So I'm going to be a new dad, and I'm going to need to be around for my family September 30th. So that's number one reason. Number two, the COVID numbers in Florida are looking a little bit dicey. So if you do go, please exercise an abundance of caution. But if you do want to go, promo code FIXnotes, you can get a discount there on diversifiedmortgageexpo.com. I hope to see you at an event someday in the near future, but it probably won't be in 2021. We'll see about 2022. All right, so I want to give you the overview here of the mortgage note industry as I see it, and that starts with mortgage note investment options. So when you're looking at a mortgage note to purchase, that's called a whole loan. It's an asset that's an individual loan secured by an individual property with a single homeowner. Now, actually, our case study today includes 2 parcels as collateral, so that isn't outside of the norm per se, but there's so many other ways to invest in mortgage notes, and I want to go through them with you here. And to start, passive investments. These are like investing in a mortgage note fund, an equity partnership with a private investor where they do the work, you put up the funds, a partial acquisition, which gives you a little bit more on the active side because you're actually buying cash flow that you have to manage yourself. Then moving up a little bit further, buying cash flowing whole loans. A partial means that there's another counterparty involved in the deal. They maybe are collecting the tail end of the payments and selling you the front end, or maybe they're splitting the payments in half, and you're basically partnering with someone who hopefully has some experience in the business. But if you buy cash flowing whole loans yourself, then you are on the hook all on your own. You have to understand what happens if those loans go non-performing. And that's why the focus of this show is buying and working out non-performing loans, because if you understand this, you can understand so many different aspects of the business, whether or not you're a passive investor or investing in reperforming loans. What do you do when it goes wrong? So we focus on the most active side of the business so that we're able to teach you and equip you for worst case scenarios, as well as the most lucrative investments in mortgage notes. Buying and working out non-performing loans is the best way to profit in this business because it also helps borrowers who are struggling to make ends meet, to make their mortgage payment, and you're able to come up with creative win-win resolutions to help them get paying again. All right, so let's talk about pricing quickly here. Pricing in the secondary mortgage market is kind of separated into these 4 quadrants for the most part. Senior and junior liens are our specialty here, and we talk about residential mortgage notes for the most part. And actually, it's funny, the case study this week is actually a commercial. You'll see when we get to the case studies. So reperforming loans are at one point non-performing and are now paying again. Non-performing loans are in default and are not currently making payments. So when you're buying a loan that's cash flowing, that's performing or reperforming, as you see it here, that means that the borrower is actually producing some cash flow every month. So then you can price those cash flow based on yield. Now, just like when you buy a property that cash flows and you look at a cap rate, a yield is basically the amount of return that you're getting on your money every single year. In senior liens, we see lower yields of 7.5% to about 12.5%, sometimes higher, sometimes lower based on some other details when you get into the due diligence process. Juniors are priced higher based, 10% up to 20% or more your cash on cash yield, your annual return. Now, when you get over to the non-performing side, you can't price based on yield because there is no immediate yield. You're looking at a discount. That's why these are called discounted notes. You buy based on a discount to fair market value in senior lien or a discount to unpaid principal balance in junior lien. The reason we do it that way is because senior liens, you are secured by the collateral either way. You're secured by the actual property, but in first position loans, you often have to take back the property. Either the borrower wants to deed it back to you, or they're not interested in keeping it and they let it go through foreclosure, or there's some other situation that occurs that you end up with the REO, the real estate owned. That means that you take back the property, the deed to the actual home or vacant land or whatever is securing your note. Now on the junior lien side, more often than not, we see junior liens resolved through the borrower. A lot of times, especially because of the due diligence process for second liens, you can identify pretty early on that that borrower wants to keep the home. Either they have plenty of skin in the game, there's a lot of equity, they maybe live in the property, but in some sense or another, they're going to get the loan performing again. So you price it based on the unpaid principal balance because you're not expecting to take back the collateral. Of course, you do want to price these loans based on equity, and you do want to price senior liens based on the unpaid principal balance, but these are the primary driving factors. And on fair market value, we're talking 8 to 8.5% to 83% or even more of the fair market value when you buy non-performing seniors. And on junior liens, 5.25% to about 75% of unpaid principal balance. And I've seen some junior liens trade for 80% or more of the unpaid principal balance, even when they are non-performing. So the real way you have to determine that pricing, though, is by looking at the non-performing waterfall evaluation. Oh, here's the wrong camera, but Hey guys, this is the desk setup. We've got the A10 Mini working our cameras. We got the Rodecaster working our audio over here, but that was absolutely the wrong button here. So for the non-performing waterfall evaluation, you want to start at the secured versus unsecured level. Now, we've talked about this a couple of times, actually many times, every single episode, I think, and we've drilled into all of these different attributes down the list, the different stages of the waterfall evaluation, and why we take these in the specific order when we're evaluating mortgage notes. So I think it was like 10 episodes at this point. 10 episodes ago, we did secured versus unsecured. We talked about how loans are secured when the property owner equals the borrower. We talked about how liens become unsecured, how notes lose personal liability, and some flags to look out for. So rewind to our previous episode to get into that detail. We also talked about junior versus senior liens in our next episode, and you can also review the more specific details on that slide if you go back to the previous episodes. Then we talked collateral valuation methods and why using recently sold comps and a manual review, often using just a simple Zillow search, can be the best bet to analyze the property value that's underlying your mortgage note as collateral. Then we talked bankruptcy, the differences between Chapter 7 and Chapter 13, some real tactical details getting into review of bankruptcy. Then we went over occupancy triangulation and why a borrower who lives in the subject collateral is a more valuable asset and it can be priced into your due diligence. Then we talked title reports. We showed you a actual O&E from protitleiusa.com. You can actually use this link at the bottom to review that document now, or you can go back and I'll walk you through it in the previous episode. Then we talked about senior lien status using the pay string and all of the other details that you get when you are actually reviewing a credit report: balance, past due, payment amount, reported date. And by the way, I offer a 14-minute training in the Mastermind. It's a free offering once you're a Mastermind member, where you can actually review everything that I review when I look at a credit report. Actually, it's the same video I use to train my staff on credit report review. All right, so now we're into the very end here. We went through all of these steps on the first lien side and the second lien side, and we're down to equity. So let's zoom in on equity and talk about this last piece of the non-performing waterfall evaluation, at least for the time being. Now, let's start out with some formulas and then we'll actually show you them on Excel. So the Excel formula for second lien equity analysis looks like this. First, you have to calculate the equity coverage. Calculating equity coverage is a pretty simple formula. It's the fair market value minus the senior lien unpaid principal balance. So that gives you the equity above the senior. And then if you divide that by the junior UPB, then from an investor's perspective who's buying the junior, you can see how much coverage you have above the balance of your second lien. So let's look at that into stratifications. So once you have this number, this equity coverage number, if it's 2, that means that the junior UPB is 25,000 and the equity fair market value minus senior UPB is 50,000, as a really simple example. If it's 1, that would mean that the junior UPB equals the equity above the senior, or any number of the range, which I've defined here. Now, this is a formula that can be adjusted based on your own risk tolerances or your own decisions on how you perceive equity in a property. But the way we look at it is an underwater flag, basically, and you can see that here, if the equity coverage is less than negative 0.25%. So we're pretty conservative there because essentially the loan, we're saying that it's actually, this is the opposite of conservative, because we're saying that the loan is underwater, even if it was, it wouldn't be underwater, it'd be actually no equity if it came up to this line here. And I'll explain this chart in just a minute. Now, if the equity coverage is less than 0.25, but greater than negative 0.25, it's no equity. So that's where we're really being more conservative, because even if there is about a quarter of the junior UPB covered by the equity above the fair market value minus the senior UPB, we're still calling it no equity. So this is a conservative way to look at no equity. Now, if we get over to partial equity, this is between 0.25 and 1. So we're saying it's partial equity even if it's fully covered. Another metric that we are treating pretty conservatively. So if you look at partial equity, it goes all the way up to 1, where the junior UPB equals the amount of equity, fair market value minus senior UPB. And then finally, full equity is greater than 1. So when equity coverage is more than 1, like in our example of 2, which would be the UPB being half of the fair market value minus the senior UPB. So it's covered doubly so by the equity, the positive equity in the property. That means the borrower has a lot of skin in the game, and we call it full equity. So basically looking at the fair market value of the property, wherever it falls on this line in terms of the equity coverage is where we're defining it based on these strats: underwater, no equity, partial equity, or full equity. And this formula calculates that for us. So let's jump over to an actual Excel spreadsheet here, and we can pop it open and give you a little bit more detail about how this formula actually works. All right, so we've got a list of assets here. There's 38 loans. We've got the asset type being non-performing second position. We've got our fair market values. We've got our senior lien payoffs. We've got our unpaid principal balance. This is the junior lien. And then we've got our equity coverage and our equity strat formulas. So as we discussed, the equity coverage formula is C2, which is fair market value, minus D2, which is senior lien payoff, divided by E2, which is unpaid principal balance. And we use some parentheses there, so we capture the positive equity and then divide that by the unpaid principal balance. So let's run that formula down. There's a couple ways you can do it. You can double click it, you can drag it, you can do Command D. But in this case, I just double click that little button in the lower right-hand corner of the cell. And now we can see the equity coverage numbers. So this one, and to make this even more easy to understand, let's just isolate the equity number here. We'll do fair market value minus senior payoff. And this will give you a better idea of what we're actually talking about. So this first one is just shy of 1/10, 0.09. And 0.09 means that there's 367,000 of principal balance in that second lien, but we've only got 34,000 of equity. So only 1/10 of the unpaid principal balance is covered. So we're calling that no equity. That's certainly no equity. Now, if we double click this as well, drag that down. This next one is negative 50%. There's negative 60,000 of equity covering a $108,000 balance. That's underwater. Basically 1.21 negative. 120,000 negative equity covering 99,000. That's totally underwater. Here's a partial equity. 66,000 of positive equity covering a $79,000 balance. That's a 0.84 equity coverage, which works out to partial equity. And if you look at the formula here, just so you understand how it works, we're basically just using an if and capturing the field for equity coverage, and then just defining with the parentheses here what we want returned in each of these cases. Now, if there's nothing there, it would be unknown, and we can price it accordingly. Now, full equity, 1.8. Now, this is a good one. 117,000 of equity covering 65,000 of balance. That's almost 2x coverage, 1.8x, which we call full equity. So now we go down the list. We've got all of that formulaically processed. Before you get to this point, you would want to review the credit reports to get the senior payoffs. You'd want to review the recently sold comms to get the fair market values. And of course, you'd have the unpaid principal balance from your loan seller. And then you can just plug all this information in, add these formulas. You really only need these two. And then that'll give you your equity strats. Now, you can do a lot with this once you have these equity strats. For example, let's take the full spreadsheet here and do a little pivot table, because a pivot table is a really nice way to visualize, and I'm going to the wrong place, tools. Where's my pivot? There it is. I was in the right place. Summarize pivot table. We'll add it to a new worksheet here. And the reason that isn't working is because a pivot table will not work when you have a header missing. Now, we don't even need that. Well, we'll leave it so we can at least get that piece too. So we'll just call that EQ for equity. All right. And we'll go data, summarize with pivot table. So now we've got our pivot table popping up on a new sheet, and we've got all of our field names. Now, this is a real quick primer for pivot tables. We've talked about this a couple of times on the show already, but I want to just walk through it again with you here so that you understand if this is just the first episode that you're tuning into. So we're going to take equity strat in our rows. So then we're going to get all of our equity positions in these separate rows, and then we can look at a couple different values. We want to know the total unpaid principal balance. We want to know the total fair market value. We want to know the, let's actually throw in the equity, because we can see actually in a dollar amount how much equity is in each of these buckets. And then we'll also throw in asset ID, because this will give us a count. All right, so now we've got a couple of different fields here. We want to turn these into dollars so we can see with the comma. And we can see if we filter this. All right, it's already in good order. Actually, no equity should be low. So we'll just drag this down. All right, so full equity, and it's a pain. Maybe it's just Excel for Mac, but it always reverts my formatting when I change the order. All right, so full equity, we've got $384,000 of principal balance, 4.1 million of fair market value, $1.8 million of equity, and 27 assets in this bucket. We've got a partial equity bucket of $97,000 of balance, 3 assets, no equity, there's 2 assets, underwater there's 6 assets. Now this gives you a snapshot of all of the different strats that we looked at throughout the equity in this portfolio. If we added in a separate column here, for example, if asset type included some different asset types other than just non-performing seconds, we could throw that. Let me actually change the order. We could throw that in there and see actually a breakdown. So we could see the breakdown of all the non-performing seconds. If there were seniors in here, we would see that list as well. And we could use a tax balance to calculate our equity in the senior positions. You basically insert the unpaid property taxes instead of the senior balance when you're calculating these. And you can run that pivot table with all of the portfolios so you can get a high level look at exactly what's going on. This is a great thing to do as an investor who is, or working, if you're working for an investor, you can summarize their portfolios for them to let them know exactly what they're looking at. You can use this information for your own benefit. You can use this when you're raising capital. You can show portfolios that you're looking at acquiring and then summarize them into a nice report for your potential investors. Pivot tables are so important, and I would highly recommend learning more about them through other YouTube videos or Google Excel tutorials and learn what you can about it, because it is so very important and super helpful for you to understand. So let's jump back into the presentation here, and we'll get on to the next slide, which I believe we just pop over to tech tips. All right, tech tips. This is going to precede our main topic today about raising COI versus note investing. So let's start with the hardware and the software in this business. If you've got a capable PC and Mac computer, a decent smartphone, and connection to the internet, you can run this business from anywhere. You can plug in a bunch of different software and web services like Podio and Right Signature and Pacer and just your simple Gmail, Zapier, Zillow, CoreLogic, DataTree, ProTitle, Google Sheets, Excel, TransUnion, and TLO as some of your data sources. There's so much you can do with these tools that are available to us today. It's amazing what's possible through the internet just from your home office. So I would highly recommend that you look into some of these services, for example, Podio. Now, Podio is what we built the Mortgage Note Mastermind on. There's no additional fee to use Podio. You pay your mastermind fee, and Podio is included in that. And you can start to understand how Podio works and how it can be leveraged in order to manage your portfolio of mortgage notes, as well as your contacts, your vendors, your investors, your attorneys, your realtors, all the other contacts that you use to run your business. So we've went through all of these in previous episodes. And I would, if you maybe want to comment, if you're interested in me running through one of them again, or if you want me to point you into the direction of when we covered these topics in previous episodes, definitely let me know in the comments down below. It would really mean it a lot to me if you commented. And we're shooting for 10 likes this video, so please like the video and let's see if we can reach our goal of 10. All right, so let's jump right into it with raising COI and note investing. So I'm gonna pull myself off of here, and then we're gonna go check on our fish. So let's see how they're doing. I was thinking maybe we'd see a dragonfly, but no dragonflies yet. And oh no, our featured guest, the koi, the camera has died on us. So we've got this camera for now, and hopefully I'll be able to reboot it and we can feed them at the end of the show today. But let's just hop right into it. Raising COI versus note investing, and the similarities which may surprise you. So here's a little video in lieu of our live shot with our good friend Poseidon, the largest fish you've ever seen, who you will never see again, because unfortunately he outgrew the pond. But that's our friend Poseidon and all of his little minions swimming around as well. So we're going to talk about a couple things here. First, we're going to talk about high quality food and seasonal feeding and why that's important for COI and how it can be related to mortgage notes. Then we're going to talk about systems, your pond system, water testing, and getting the best fish. Then we're going to talk about protection from predators and overpopulation. Actually, one of the reasons why we haven't seen many COI today is because the heron has been on the hunt this week. We've seen our great blue heron attack our COI, and we're hopefully not going to see him today, but he's came over the last week, I think 2 or 3 days in a row, and he is persistent. Me and little David Rose, the Westie, will go out there and chase him away, and he'll be back in 10 minutes. So that's why we maybe won't see the COI today. So let's talk about high quality food and how that relates to mortgage notes. So first of all, what is the food? I mean, it's knowledge. You got to seek out the very best information for the fastest growth. And at different times, you need different food. In the koi world, you want to give it a high protein food when the water temperatures increase and their metabolism speed up so they can grow very fast and develop beautiful colors. In the beginning of the season, you want to feed them not as high protein foods. There's more wheat and other ingredients in the food because their digestion is a little bit slower. And in the winter, you don't feed them anything because their digestion just slows down completely and they can't process the food. So to relate this back to note investing, there are different seasons for everything. And you want to make sure that you are exercising the right activities at the right times. And we'll actually get into this in a minute in the seasonal feeding slide. So let me not jump ahead there. So the context here is really to watch videos like this. This is totally free. I'd also recommend Bill Bammel's series on win-win resolutions or win-win investor. He's got a great content that comes out on a monthly basis as well. You can Google all sorts of other information on mortgage notes, including, of course, the course. Yeah, of course, the course Mortgage Note Investing on FIXnotes.com, which is totally free. And then when you're ready, join the Mastermind, because that's where the best network of investors are coming together to discuss things in the forums, to keep up to date on everything. By the way, Bill Bammel, who I just mentioned in his YouTube show, he's one of our members and he presents. He's had 2 presentations this year in our Mastermind members only call, which have both been awesome. So I'd highly recommend you come join the Mastermind and you can check out the recordings. So let's talk about seasonal feeding next. So observing business cycles and applying your efforts when the market is ripe. There are certain times a year when the bankers go on vacation, when there isn't as much going on, when the market sort of freezes over. And it's kind of been a prolonged freezing over the past year because of COVID and some of the new regulations, the foreclosure and eviction moratoriums, the lapse in the accounting regulations so the banks don't have to report their distressed assets. So this is a great time to be gearing up and to be learning so that come 2022, you are ready to start sourcing assets and take advantage of an influx of non-performing loans and borrowers that need our help. So also, don't overeat, balance gathering info and taking action. It's really easy to get in a position of analysis paralysis where you really, you don't ever take action because you have to keep learning and learning and learning. So make sure you prepare yourself adequately, but then you got to do something. You got to take action, even if it's to purchase a small loan to get your feet wet. It will definitely benefit you tenfold to actually do what you've been learning. The knowledge will just solidify so much better. So don't overeat like these guys. These guys are hungry fish, eating everything. Actually, they're not overeating. We don't overfeed them, of course. But that's just a photo. We'll look at one more video of them in a minute. All right, another one, set up your systems. This is so important, maybe the most important thing on this whole presentation. You want to document procedures and execute them diligently. If you document your procedures, you can better automate those procedures. So by setting them up, these systems properly, you can basically scale your business in a way that's very, very consistent and formulaic. A great thing about documenting your procedures and processes is that if you hire a developer or you start to apply those procedures into automation, it's already all written out and you can refine and optimize those systems and procedures and processes as you go. So in the koi world, our pond is kind of symbiotic. We've developed a symbiotic relationship between the plants and the fish and not the heron, because although I would say that the heron would help in culling the herd, which we'll actually see in another slide very soon here. But very important to set up your systems. To have a good pond pump and a good filter is imperative in the koi world, and to have great technology in the investing world is going to make your life so much easier and essentially make it possible. And this was another call, another presentation from another member, Lisa Lemire, in our previous, actually it was our last private members only call, about how she runs her business pretty much solo with her and her husband. She delegates a lot to third parties, and she's able to, because of her systems, run a very lean operation, which is really great. And personally, my approach, I have one employee, actually 2 employees now, and I try to keep it lean to automate whatever I can, and then make sure that my staff, my employees are equipped for the most success. So let's talk about testing the water. Testing the water in the koi world is so important to check the KH and the pH, to check the ammonia, to check nitrites in the water. And in the note investing world, it means auditing your portfolio regularly, identifying issues ASAP so that you can address things before they become a bigger deal, before they become something that is actually going to affect maybe the secured status of your loan or wiping out the value of one of your properties. So definitely audit your portfolio regularly. Check property taxes, check senior lien balances. We've talked about this on many episodes in the past, so I'm kind of just giving you the high level here, but it is so important to continually audit your portfolio. And you're maintaining homeostasis. You're balancing your acquisitions and your dispositions. You're not just going all in on buying loans and not focusing on the loans you already own, or you're not just focusing on the loans you own and not being active in the marketplace to continue to supply assets to your portfolio. You're maintaining homeostasis to keep a balance in your portfolio, just like we strive for a balance in our koi pond. Let's check on that, by the way. Oops. Yep, that one camera is still dead. Now there's just a lovely trickle growing. Let's see if we can hear it. Where's my audio? Oh yeah, no, we can't hear it. I guess that that camera doesn't have a decent microphone. All right, one more video for you, and this one is a fun one. Look at those happy fish. When they're not scared of the heron, they're just loving. I mean, maybe they just want food, but they swim right up into your hand, and it's really, really nice. I would never have guessed that we would love having these koi as much as we do. When we bought this house, we did not really think of the koi pond as a selling feature. It was kind of more of a, I don't know, just another thing we'd have to do. And now I gotta say, we really love these little guys, so highly recommend it. Great little fish. All right, and speaking of, you gotta choose the best fish. So we picked out for my wife's birthday last year, maybe it was the year before. Yeah, last year, we picked out a bunch of our favorite koi by hand at a koi farm out in the middle of Pennsylvania. And we picked the best fish. We hand selected each one, just like you got to hand select your mortgage notes. You got to find a reputable source. Source is maybe a bank or a hedge fund or a secondary market participant who's going to be selling or introducing you to sellers of mortgage notes. And then conduct the proper DD. The due diligence on not only the source, but also on the individual assets. So super important, and we talk about due diligence so much because you make your money when you buy in real estate and investing in general. So that's something that we've covered time and time again with that mortgage note due diligence workflow, the waterfall. But at a high level, you also have to review your contract and make sure you have remedies for anything that may go wrong. And in case you do choose a bad fish, you got to be able to call up the breeder and let them know, hey, if this happens, what do you have to offer us? And the breeder that we worked with to get our fish would allow us to exchange if there was some issue that came up. Not that we're going to drive 4 hours or whatever it is to go swap it. Maybe we would, depending on if it was one of our favorite, most prized koi. Or we would treat it ourselves. And that's really what you have to do in this business. You have to be able to work towards your contract first to see if there's any remedies with the counterparty. And if there aren't, then you have to make things work on your own. You have to be able to resolve issues with collateral documents or make sure that you pay off delinquent property taxes before they might foreclose. There's a lot you can do to mitigate those risks, but the contract, if you are within the repurchase guidelines and you have representations and warranties, look for that language in your contract, reps and warrants, to make sure that you have some remedy if something were to go wrong. And then of course, you've got to protect your investment. And that's the case in koi, certainly. You've got to protect the koi from the heron and the raccoons that try to come get them from time to time. And you have to protect your mortgage notes, your portfolio. And the first and most important thing to do when you buy a loan is to record your assignment of mortgage, because then you're ready to address notices that come. Nobody knows you own the loan if you haven't recorded the assignment of mortgage to the property title. So if you go to the public records and get your assignment of mortgage recorded, which we've done a whole episode on, you can rewind and watch that one if you haven't already, then you're ready to address the notices that come to you based on your public representation. Your assignment is recorded, it's public record, everybody knows to reach out to you if there's a bankruptcy, if there's a tax balance that's due and proceeding to foreclosure, or a senior lien foreclosing. Very, very important. And you also can protect your investment by culling the herd. In our world, in the koi world, we've got some goldfish in the pond, and can't really see any there, but the goldfish populate very, very, very quickly. They multiply. And from time to time, they need to be scooped out and given away to friends or removed, fed to the birds, and that's where the herring can actually help. If the herring was selective in only eating the goldfish, we'd be in good shape. So then we have more resources for the koi, because the koi are really the focus. Just like your mortgage investments, if they are spending a lot of time, if you're investing a lot of time into a note that maybe isn't in the right market for you, or there's an investor who acquires REOs in that specific market and be more likely to proceed with a foreclosure, work with an investor who's got that symbiotic relationship where you can sell loans that don't fit your objectives anymore, and then work on just the loans that do meet your investment strategies. Some investors do the fix and flip model where they're buying loans that are non-performing, they're getting them cash flowing with a modification agreement in place, and then they're selling them to an investor maybe in their self-directed IRA so that they're able to collect that monthly cash flow and not have to do the workout process. So cull the herd, sell notes to meet your own investment strategy. So that's it for the Koi Caretaker's Guide to Note Investing. That was an interesting one. I hope you enjoyed it. And now we're going to talk about how to get on the list for future assets for sale. So our next offering date is going to be Q4. So I've kind of been pushing this back because there hasn't been a lot of assets on the market lately. As I mentioned before, a lot of banks are delaying. We actually had a really great opportunity to acquire almost 800 non-performing second liens recently. And the seller just put out a notice that it won't come out until January 2022. It's supposed to be out last week. It's been extended. The banks are kicking the can down the road. So our next offering date, loans available, should be Q4 2021 non-performing seconds. Now, if you join the mastermind, you've got total access to tons of opportunities. You don't have to just wait around until I put out another public portfolio. You can see assets from other members that are available for sale. You can see assets from other counterparties, sellers, and brokers in the business. We aggregate everything we see into the aggregated trade desk in the Mortgage Note Mastermind. So definitely join so you can take advantage of that. We've already aggregated, at this point, I did this presentation on Monday, and there was 16.89 million of unpaid principal balance. Oh, that's billion. I'm so sorry. There's almost 17 billion of unpaid principal balance aggregated in the trade desk in 2021 alone. So huge amount of assets available there. I would definitely recommend checking that out. All right, so let's get into the case studies because this is probably the most important part of the show. Put the all the things that we talk about into action here to see it on an actual asset. So this first one we're going to talk about, it's a new exit that we haven't discussed before. It's an REO sale, a non-performing first lien secured by land that we ended up foreclosing on and taking back the REO. And we sold that REO for $38,810. So in this specific asset, we had a fair market value in the beginning of $90,000. There was unpaid taxes of $7,785, which left about $82,000 of equity, securing our $197,000 unpaid principal balance. So here's a little quiz for you. What would this equity coverage number look like based on the formula we discussed? I think I've got a Jeopardy sound here. Yeah, I should have had that queued up sooner. I didn't plan on. Okay, the answer is partial equity, because this one is over 0.25. It's over 25% covered, but it's still not that covered. There's almost 200 grand of equity. There's 200 grand of unpaid principal balance secured by 82,000 of equity. Not a very great metric here. So if we go into it a little deeper here, we can see that we paid $19,809 of our actual investment, 24% of the equity, and we ask three questions when we get into these investments. What happened? Where are you now? And what do you want to do? These are questions we pose to the borrower to craft our resolution strategy. And in this case, the borrower, as I alluded to in the beginning of the call here, was actually an LLC. It was a commercial entity that owned 3 parcels. There's actually 3 lots in this specific secured interest that was protecting, or that was securing this mortgage note. So in this case, the builder went out of business. They stopped paying the mortgage. They stopped paying the taxes. Basically, things in that specific subdivision just kind of blew up. It was 5-10 years ago that this happened, and the market wasn't what it was today. So they weren't able to do any building profitably. So they stopped, and they stopped paying everything. So there was actually 3 lots originally securing the note. That's why it was so big, almost $200,000 securing these vacant parcels. And one of the 3 lots had already been lost to an unpaid tax deed. So it was sold at a tax auction, and the certificate was then converted into the deed, and the redemption period had expired. So there was no possible way to collect in the secured interest on that third lot. The other two were still secured, but they were close to their redemption expiration. So they need to be paid current to avoid risking losing the secured interest on those lots as well. So at first, the builder, the borrower, was in contact, and we were talking about a deed in lieu of foreclosure, which would just transfer the deed on these other two lots back to the investor to say, I don't want to pay the $197 anymore. I'll just give you the lots. And he bailed on us. The borrower, the builder, stopped answering calls and emails, and we were no longer able to pursue that route of deed in lieu of foreclosure. So we had to foreclose. It was the only remedy to pursue. And unfortunately, it took a lot longer than expected. This was a comedy of errors. And I'll admit, maybe some of it, no, I don't think any of this was my fault, to be honest. This is a loan I was managing for one of my clients. And I'll admit my mistake. I chose the wrong attorney because our attorneys got all the way through the foreclosure process. They were just about to record the deed, and then they went out of business. And MIA, we didn't hear from our attorney for like 6 months. And maybe that was partly the issue that I made. I didn't reach out sooner, track them down, but somewhere there was a box full of paperwork with our deed ready to send to the county recorder. The foreclosure was done, and it never happened. So, man, that one was a tough situation because we had to find the attorney, the actual person, track them down. They went to a new law firm, and then we needed to work with them to figure out what we were even going to do. So finally, we were able to get the deed recorded, and it took way longer than expected, but we could finally reach out to a realtor and start marketing these lots, these two lots that were remaining for sale. Since we finally got them into our name, we can deed them to a new buyer. So what do we want to do in this situation? Sell the two vacant lots after 6+ months of listing. So this deal took over 12 months, $8,250 of expenses that covered the due diligence, the onboarding the loan, the collection process, and the realtor fees and some closing costs are actually incorporated into the sale price. So that's the net sale price. And then I net this out to, in the final slide, give you the actual metrics for the rate of return we earned on this deal. But let's talk about a couple of takeaways here. So stay on top of your attorneys. Very easy takeaway to begin with. Don't take it for granted that they're working your case diligently. You want to stay on top of it because maybe if I had reached out within the week that they were closing up shop, we would have been able to transfer it to a new counsel, or I don't really know what the backstory was there, but for whatever reason, they closed up shop very quickly, and we should have stayed on top of them better. So also track down your tax certificate holders. So if a property tax has been delinquent for long enough, it will be sold. And it depends on the specific state that you're working in, the specific county and the process there. And by the way, plug for the Mastermind group, we have a database of states and counties, so you can see if they're tax deed or tax certificate states, how that process works with regards to the redemption timelines. So definitely check that out. But in the different processes for your tax deed, if a tax certificate is sold, you need to track down the person who bought it and then pay them off to make sure that they don't convert their certificate into a deed and remove the secured interest that you have in the property. And then other fines and expenditures, you want to make sure you understand those not only before you buy the loan, but before you foreclose, you do another audit so that you're not being surprised by those later on in the process. But one good thing that you can do, you can negotiate to pay some of these fines and violations out of your closing so that you can avoid an out-of-pocket expense before you actually have dollars coming in. So in this case, we did have in the HUD, the settlement statement, when we actually sold these parcels, we had some of these taxes and fines and stuff netted out of the sale price so that we didn't have to put that money out of pocket. We did have to spend that $7,000 or $7,785 tax balance earlier on in the process to avoid that going to a tax certificate sale as well. But fortunately, some of the other expenses we could push forward to the actual closing. So in this case, the internal rate of return on this one was about 54%. That's the non-performing loan, not resolution, but foreclosure, and then REO sale, time adjusted return. The internal rate of return includes that 12-month period that we actually worked this deal. So it would have been a lot stronger of a return if we didn't have that hiccup with the legal counsel, and it would have been a lower return if the marketing process took longer. So internal rate of return is something that we've covered a lot on this show as well, and you can definitely learn more about how to incorporate time into your rate of return using the IRR formula in Excel or a quick financial calculation in your TI-83 or whatever financial calculator of your choice. So let's jump over to the next case study here. This one's a non-performing second lien. We thought secured by a single-family residential property that was resolved in a full payoff. It's a small one, a small payoff of $4,663. Small relatively to the last deal at least. And this was a small loan, but $150,000 fair market value isn't bad. Secured in front of a $32,500 senior lien balance gives us a pretty strong equity position. But the reason why that senior balance is red and the equity is saying unknown is because this is the origination balance of the senior lien. This is not the balance that we got from a recent credit report. This is the balance that we kind of had to guess in our due diligence process based on public records and the senior lien that was originated for $32,500. And our UPB, full payoff here, $4,663. So let's talk about what happened, where are you now, and what do you want to do? So in this case, what happened? This property was condemned and razed. Raised means demolished. It was gone. It's kind of counterintuitive because you raise something up, it's spelled differently. Raising is knocking it down. And there was actually a $7,000 lien for the demolition, and there was a $1,200 fine. So there's some fees right off the bat here to eat into our equity, but there's some good news. So it's actually land. The property has been raised, and the value is not $150,000. That was when we thought it was a single-family residential property. So what's going on now? The borrower's deceased. The attorney for the estate reached out to settle after finding a buyer for this vacant land, and it's under contract already for $29,000. And great news, the senior lien has been paid down. So that's why we like to use the origination amount, because then it's conservative. And if it's been a length of time since it was originated, it's hopefully been paid down since then. So we've got full equity now, and the junior lien can get paid off. And the title attorney in this case confirmed, they wanted to confirm that the assignment of mortgage was recorded so that we could release the lien at closing. So that was really the only step here. Make sure the assignment's ready to go so that we can record the release, the satisfaction following our collection of the full payoff. So this was a pretty great deal. Collect the full payoff at settlement. And this loan cost only $1,100, 23.5% of the unpaid principal balance. And over 5 months and $425 of expenses, we were able to go through the due diligence, onboarding, and collection process. It's a pretty quick one. In this case, the title attorney reached out to us to get the deal done. The attorney handling the estate as well was working in tandem to get this property sold. We got that $4,663 payoff. Let's talk about a couple takeaways here. First of all, senior lien origination balance. If you use this number to estimate equity, you'll have a much better time if that's been paid down to be pricing based on a more conservative number. You always want to use conservative approaches when you are doing your analysis, so then you can be pleasantly surprised, hopefully. If no trade line is available on credit, or if the trade line on credit is not active within the last couple months, then you do want to use that origination amount. And then, of course, you have to record your assignment of mortgage so the counterparties can find you on title and pay you off. If you don't record your assignment, nobody's going to know you even exist. And then you're going to possibly miss something like a full payoff or something maybe on the negative side, like a foreclosure from a senior position lien, an HOA, or a property tax deed holder. So very, very important to record your assignment of mortgage. In this case, pretty strong IRR at 183%. It was quick, and it was a pretty good multiple on $1,100. So a nice internal rate of return on this deal. And that's it for the case studies today. Thank you so much for hanging in with us on those case studies. Let's talk about the giveaways, how you can get on a call with me. So the 15-minute consultation is free to anyone who hasn't gotten one already. All you got to do is subscribe to this channel, like this video. Like I said, we're going for 10 likes this episode. Please try to help us get past that 10 like number, and leave a comment with any questions or comments. Comments are huge and really help with the YouTube algorithm. So please leave a comment. I try to answer them very quickly. So if there's anything you need to know, I'd be happy to answer there. So you can then book that 15-minute consultation at robbymax.youcanbook.me. You can get on my calendar and we can talk shop. Really whatever you want to talk about. I'll be happy to help you get the next steps going in your note business or your real estate business or your YouTube presentation career. I've been doing this now for 36 episodes, so hopefully I can teach you something there as well. So let's just go over this upcoming schedule next. We've got our mastermind call coming up. That's this first Wednesday of the month. September 1st, 2021. Then we've got our final Wednesday for the next episode of this show, Be the Bank, September 29th, 2021. So definitely tune in for both of those. And we've got, of course, all of our resources here for you. So like I said, I actually messed up. This is $110 per month now. We have 8 seats available at $110 per month before we go up to $120. So it increases by $10 per every 10 seats. So definitely check that out. If you are already a member of the Mastermind, go to podio.com/FIXnotes/mastermind, and then you can get into the group. And if you are interested in joining, or at least trying it out, there is a money-back guarantee on the Mastermind membership. In the first 30 days, if you're not at all satisfied with maintaining your membership, just let me know. I process payments through Stripe, so it's super easy to just offer you a refund. So please just try it out. And if you don't like it, ask me for a refund. I'll send you your money back. So go to FIXnotes.com/MNM or /mastermind to read a little bit more about what this group offers, and then join and see what you think. And by the way, I mean, you can join, look through all of our resources, watch all of our calls, and then leave if you want to. I don't think you will. I think you'll find it totally worthwhile if you're serious about this business. So definitely check it out. All right, everyone. That is it for today's episode. Let's say hi to our no dragonflies still. And we haven't said hi to any birds either. So I think the birds are a little confused since the feeder has been missing for a month, and now we've got approval by the Audubon Society to put the feeders back out. And by the way, just to close the loop on this one, I mentioned when I told you about this blight that I think I mentioned this to you guys, that it was probably the cicadas because the brood X came out and they've been marinating in pesticide-laden soil for 10 plus years, and then they come out of the soil and the birds all eat them, and then the birds have some adverse reactions. And apparently the fall of this blight has coincided with the dormancy of all of the cicadas. So that was the initial hypothesis, and I believe that it was proven, and now we're safe to feed the birds again. So hopefully next episode, the birds will be back in action here. We'll see some woodpeckers and some titmice and some blue jays and all of our friends. But for now, we're kind of not having any friends today, even the koi. All right, so what I'm going to do to close out the show here, I'm going to go hopefully get camera 4 activated and then feed the fish. We'll see if that works. If it doesn't, though, I do apologize, but we're just going to try and make that happen. Thank you again for joining. It's always a pleasure to present the show to you. If you have any questions at all, please leave them in the comments below this video, or if you go back to our previous episodes, you can leave a comment on episode 1, and I'll be back to let you know what my answers to any questions or comments that you have. And until next time, which will be next month in September, I will most likely be a father by September episode. So I'm very excited to share that news with you when we get back on the show. And in the meantime, please join the Mastermind to get on our September 1st call and to get access to all of the previous call recordings. You can hear now from, what are there? 8, 9 different episodes of our Mastermind members only calls with 2 speakers in each call presenting topics ranging from business development to tactical due diligence strategies to working with vendors and everything in between. There's so much for you there, and I hope that you join, or at least consider joining. Go to FIXnotes.com/mastermind. All right, so this camera, I'm gonna just shift to it. It might just stay black, but it just might show you some koi feedings. If not, I'll have to shut down the show, but I'll see you guys next time. Come on, fishies. Come have a snack, everybody. Just wanted to say hi one more time. I think that the fish think that the stalk that this camera is on, you can see it like up here. I think that they think that's the neck of the heron trying to eat them. So we maybe won't get to see a real good shot. They're so skittish right now. It's been a rough week for the fish. But thanks again for stopping by, everyone. Hopefully next week we'll have the birds and the fish, maybe even little David Rose featured again on the show. So I hope that you have a wonderful month. I know I will. And we'll reconvene in September for another episode of Be the Bank. All right, that's it, folks. Thanks everyone for joining.